it is a two-sided trade.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you, and I'm joined today by Joe Kemp of Comstock Investments. We'll dive into Wednesday's markets. Overall, looked like a pretty decent, solid session for the grain.
Follow through from a mostly higher Tuesday. Tuesday was a turnaround from a slightly weaker finish to start the week on Monday. It was really a two-sided trade. Ultimately, the strength that's been generated and some of the traction sustained on today's move was not only technically supported and positive outcomes there to speak of, but it was an example of the two-sided nature relative to the recent couple of weeks that mostly saw weaker trends, especially for corn and soybeans. So that came into play as we began this week, that some of the futures were looking at least short run oversold on the perception of speculators that were also freshly bearish, and that true too of the commodity trading funds, knowing that they flipped quite aggressively from net long to net short in corn last week, that they were still pushing the pedal down on a near record net short across the wheat space. Some general short covering here, maybe getting an early start on that ahead of the long holiday weekend we've got coming up. But general profit taking plus bargain buying, I would say, leading to these couple of sessions higher.
On the July corn chart, it looks like we just kind of poked our head above the 20-day moving average. However, I think what might be more important is it's now bumping up against the 200-day moving average. That could be important if it can climb above that.
Yeah, and that's a quick turnaround then. We had lost support from that 20-day. I like to watch that 20-day real closely for the short run, and seeing that came into play in so many markets. It's true of the soybeans that have now flipped just back above it. Once they lost that mark earlier in the week, they didn't go a whole lot further. You've got a similar looking chart, of course, leading the soy complex lately has been bean oil, back above the middle of the range there. And then on corn, that big flip here takes us right back into the top half of the range and allows for some semblance of a savior from what looked to be contract testing recent lows. And so far, too, holding up the gap that was left open on the chart when the May contracts expired. That could still come into play later, but for now, an area of buying interest. We've talked before about $5 and that psychologically important even money mark for wheat, both Chicago and Kansas City. And here, the settlement today, just a hair short of $5.50 for Chicago and above $5.40 by a fraction for nearby Kansas City wheat. That's a long ways, at least, from $5. So the sentiment has turned notably less bearish, I'd call it, more friendly somewhat. But it feels like, too, a market that's waiting for what's next. And you can see that also in the volume numbers, the open interest, the definition of the attention on spreading over a lot of directionally type of heavy moves. So we know more can come. Long weekend. We've talked so much about how important weekends are and what can pop up over Saturday, Sunday, and now in this case, Monday. And it could be this type of trade, a mechanically, technically driven positioning ahead of the weekend type finish. But 2 more days, we'll see.
Yeah, so it seems like the technical factors are the driving force here in the markets. If that weren't the case, what would the fundamentals be that are affecting the markets right now?
You should have some of that in play given the time of the year we're in and the advancing planting season. And that could be the partial spark earlier for the technical move that clears the way for some of that buying. The algorithms trigger and the discretionary traders make the decision to ultimately cover those shorts or take some fresh long interest in this market. But it would be on the basis of weather. In a weather market we're in, we have the recent rains leaving some folks soggy and ready to see the sun, certainly. Others, much needed moisture. We know that the numbers are up there and there's not major alarm in a lot of places, but at the same time, if we rewind a week ago, it looked like, it's just, and talked about, it's just wide open. We're going to have this crop in. We've got, a beautifully wetter 6 to 10, 8 to 14 day outlook period. And so let's take some risk premium out of this market, and the traders did that. Now, though, it's not quite as rosy again as we thought maybe 7 to 10 days ago, and there's still going to be those challenges in spots, not only where they might have to replant or still straggle to finish the last bit of it, but eventually where we see the further out forecast or the outlook flipping back drier, and that being the return towards a drought threat that we know is likely still going to be in place this summer.
You mentioned the wheat market earlier, and of course, a week ago, we had the Kansas Wheat Tour that took place. And overall, it seemed like the participants on that tour were pleasantly surprised with what they saw. The wheat average actually turned out better than what they expected to find. And yet, that seems like that almost put a low in the market. I think the low was maybe a couple days before that. Can you explain that?
A couple of days before really we started to get into the Kansas crop tour was the USDA May crop report, and these next look at new crop estimates, but also updated yields for the winter wheat crop. And what we'd observed was that the Kansas tour did largely support what were slightly higher than expected production estimates that came out of the USDA a couple of Mondays ago. But you get into that tour, and confirming it is one thing. You can also potentially put in a low, though, if you feel like that confirmation, those USDA numbers are about the high watermark of it, and that there's still in many cases 2 to 6 weeks before we're going to get into the thick of it, and maybe we'll prove these more optimistic expectations, or maybe we have room to be slightly disappointed or miss. And so it can be that feeling of, okay, we've seen likely the higher number, and now we've got more risk to shoot less than that, and therefore let's put in, at least temporarily, a low in the market, and then wait and see what happens when we really get into it.
Well, we took about almost exactly $1.50 out of the Kansas City wheat market since mid-February. We've gained back about 50 cents. In other words, roughly just about an even third of that. How much would you fully expect that the market can actually recover from that drop and still be realistic about it here before harvest?
Right now, there's just so much focus on the $6 handle, and that being that next major mark. It fits with recent highs that we've had this year around that level and just short of it in both Chicago and Kansas City. So Chicago up to $5.75 to $6 is clear chart resistance, plus the even money psychological aspect of it. The thought that for farmers, they would be much more eager to sell with futures and a 6 handle than they are right now, and that they'd have more ready here in a few weeks, presumably what it would take to get that next, say, 50, 60 cents. And so we're not getting too excited beyond that level to put that into perspective, like you did, saying that we have over these last several months dropped $1.50 or more. And so to recover another 50 cents or about $1 in total off the recent low would really be an achievement. But it might be, a stretch to think of for a whole lot beyond that. And that's why it's really similar for wheat like it is for corn and soybeans. And we touched on this in previous conversations about these just big levels, these ranges that we're in. And for wheat now, it's between 5 and 6 on Chicago and Kansas City. For soybeans, it's 10 and 11, and for corn, 4 and 5. And now we're in the upper half of those ranges in a lot of cases, almost there, as mentioned, for wheat. And so you can see what happens when we get up there and imagine that there might be selling interest on the basis of recent highs and having just been there not long ago, and then also on the time of the year it is and the willingness for farmers to advance sales at those levels.
Well, I see where the dollar index value dropped significantly today. How much did that help the grain market, do you think?
I think it was a major impact that we'd see continued tailwind provided by the lower dollar in export demand, in general investment interest that you're going to see possibly rotate into the commodity space when the dollar's lower like it is. And the outlook is not just for the dollar having been lower to support current business, like for commodity exports, for example, but for a continued decline in the dollar being more likely as we have these various signals from the White House, President Trump, and his goals. We know about the trade policy changing, and one thing that can help close the trade deficit to boost exports and to curb imports is going to be a softer greenback, and we're getting that. So there can be a lot that's positive going on with the dollar. Now we're going to see how it dovetails going forward with changing interest rates in a big way. That's been such a subject of conversation overall, that interest rates keep rising, sort of against the will of monetary policy and even the federal government for that matter. So something worth watching, as always, these big outside financial markets for what they're going to say about potential in our grains and livestock.
Yeah, and I was just going to transition into the livestock discussion here. I see where the equity markets, they had moderate losses early in the day, but they seem to really accelerate. And I mean, it turned into a sharp sell off by the time we got into the afternoon. And I just wondered how much pressure that actually put on the meat complex. Looks like live cattle hung on to some small gains, but it seemed like overall it was kind of under pressure.
Yeah, it did seem to limit upside, as we've observed so many times. Lately, it's been more of the tailwind because you have these stock index having returned to just short of their all-time highs, or back to, in many cases, where they had started tumbling in early April when the tariffs were first being launched to a bigger degree. So you have this relative stability being interrupted today, and I believe limiting that early strength that we had in the cattle, but then it being, at least not yet, quite so negative as to put a dent in these still positive gains that you mentioned for live cattle. And that has to go back to still the fundamental aspect of having made a correction and then having the board still under the cash trade for all purposes. If we look at June now, up front at just over 214, and still talking about a cash trade that's well supported, as far south as you can go at 220 and above. And that's the positive leaning as we head into the end of the week and we think about where we are going to see speculators put their wagers on relative to the next cattle on feed report coming up.
Well, the August feeder cattle, they still have that gap on the chart from a little over a week ago. Some folks say, well, they're going to have to go back and fill that. What do you think?
Yeah, there's a gap left there on the way down, but also a gap down below the market from early in April, and so you're back in between that. They're going to call it both ways, technicians, that eventually you're going to see that tendency to go fill the gap. Right now, it seems that that's more of a resistance level than what could be risk to fall down towards that lower end of the market. But yet to be determined. We see the biggest thing into play would be these like, for example, feeders back below 300, losing that initial support on that level, and then bring up the 20-day moving average again, and how the nearby live cattle futures have backed off to just that level and have so far held.
Well, looking at the lean hogs, they seem to be content to just chop around sideways here for about the last month now.
Yeah, they had quite the recovery out of their early April lows, in part assisted by the run up again for cattle futures. You have that complementary, that substitute effect between the meats, certainly. And we think more and more about that as we head into the summer grilling season. We'll kick that off with Memorial Day here this weekend, and knowing the record price of beef and the relative disparity between the two markets, and that should be supportive for pork going forward. And in a market that itself is already short supplied, you can see that being maybe more of the upside influence that we've enjoyed these last several weeks. But then, as mentioned, now kind of consolidating and wondering, like for the cattle market as well, are we past to that seasonal point where we've really stocked up for the start of the summer season? and that we're now waiting on the onus of demand to prove out that we can keep stocks as tight as they are. So it is a two-sided trade for the hogs all of a sudden these last couple of sessions.
Well, next week's going to be kind of interesting. I assume we'll still be able to have our regular update on next Wednesday, but it will be a short trading week, and it'll be the last trading week of the month as well after Memorial Day. What do you look for when you have a weird situation like that? A short week and end of the month trading at the same time.
Yeah, you can't have those instances of position maneuvering or squaring coinciding with moves that could be exacerbated by, for example, lighter liquidity if traders are maybe lagging after a long weekend. But this one doesn't necessarily coincide with a lot in terms of expirations or, in the stock market, these double or triple witching environments. There's not necessarily a whole lot lining up relative to Memorial Day. So I think it goes back to what I mentioned. We've been looking for now every weekend, since the start of the year, or since Inauguration Day, maybe more aptly, watching over Saturday and Sunday what developments take place. That included, the last weekends with the Chinese trade deal and these announcements, including from USDA Secretary, right, in the cattle market about banning imports from Mexico again, announced on a Sunday. This is now 3 days where, anything can happen. And so regarding that influence, we know there's a lot of moving parts still open, like on the budget talks. And I think that could dominate these next couple of days and extend into next week, especially if the House passes a bill and gives it to the Senate for consideration.
It seems to me that options are made for extended weekends and holidays, right?
You have certainly a position to take on volatility when you're trading options, and for that reason, they're talked about more in that context for sure.
Fear of the unknown. All right. Well, thank you, Joe, for talking with us. Always a pleasure. We'll catch you next week again. Joe Camp of Comstock Investments with us. That'll do it for this episode. Thanks again for joining us. For Brianne Jenkins, our producer, I'm Marlin Bohling. We'll catch you next time here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.